Real estate investors, listen up. If you have kids and you want to know how you can write off the things that you buy for their everyday wants and needs, then this video is for you. Because I have a game-changing strategy that will not only boost your profits, but reduce your tax liability.
What you talking about, was?
I'm talking about a strategy that's the most powerful and underutilized tax strategy by most real estate investors. So your days of coming out of your personal pocket for your kids is over. By the way, if you are new to me, my name is Nikki Burns, and I help six-figure multifamily buy and hold investors save on average $50,000 in taxes and maximize their cash flow so they can add more doors to their portfolio. Before we go any further, hit that like button and subscribe to my channel so we can help other real estate investors find this video. Now let's dive in. Now this game-changing tax strategy that will allow you to write off $13,849 per child in 2023 is putting your kids on payroll.
What?
Yes! When you put your kids on payroll, the wages that you pay them are a business expense, and that will help reduce your tax liability on your tax return. So if your business is a sole proprietor, a single member LLC, or a partnership in which each partner is the parent of the child, then wages paid to the child are not subject to income tax withholding as long as you are paying each child under the minimum filing requirement threshold, which is $13,850. And that is for the single filing status.
What was that? What did he say?
And if your child is under the age of 18, then their wages are exempt from Social Security and Medicare tax. Now you may be wondering, why is that? This is because they are still a minor and you are legally required to provide for their essentials. You know, food, light, gas, water, shelter, etc. And the IRS assumes that your children will not sue you because you will have to take care of their needs anyway. If your child is 18 years or older, then their income is subject to Social Security tax and Medicare taxes. But watch out, because if your business is a corporation, an estate, or a partnership where both of the partners are not the parent of that child, then you must pay payroll taxes. But hold on, I know where you're probably going with this. There is an upside to this. And in order for you to avoid these payroll taxes, you will either need to pay your child under a sole proprietorship or an LLC. We recommend setting up a family management company structured as an LLC or a sole proprietorship, and have your S-corporation pay the management company a management fee, so that way the fees that are getting sent to the management company will be dispersed and paid to your children. But there's more to it. And once you have that family management company set up and everything in order, then you can go ahead and add your children to payroll. And how you do that is you have to do it the legal way. So you have to have a legal job description, you have to have timesheet trackings, and you have to fill out all of the different tax forms, the same process that you would go through when you are hiring a non-family member. So you have to follow that same process. Now this tax strategy may seem easy based on how I'm explaining it, but there are additional steps that you have to follow in order to set this up strategically and the correct way. Because one mistake, one tiny little mistake, will be costly to your business, and you will incur penalties and even miss crucial deadlines. So you want to get with your tax strategist to help you follow this and get everything set up correctly. So if you're interested in implementing this tax strategy, paying the least in taxes and avoiding penalties, then click the link below in this description to book your free tax strategy with me, and I will see you guys on the next video.